All right, folks, welcome back. Well, we were in this area here, and I mentioned that I felt that it was going to go below the 100 level. And if I were making the market, in other words, if I was the market maker, providing the parameters at which the dollar index will go down to set up a buying opportunity, I would take it down to the 99.92 level. Why did I pick the 99.92 level? Okay, well, if you look at the price action right over here, okay, we had this run up at the beginning of that candle right there. Just draw that out in time. I gave you about 99.95, 99.92 level. Okay, that small little range of about 3 pips. And just eyeballing it. So that's what I was looking at. I expected it to drop down. I'm not convinced that we're going to see this top yet. So I felt that it dropped down here. And also, being a setup going into London, that's what I would expect. And I'm going to teach you how to use that information if that's what you want to investigate and study on your own. But notice that we ran up above these relative vehicle highs, and that's what we ran for the intraday price action target. So the high of the day that was set initially around the midnight time frame, it dropped down, creating the entire run lower, creating the London low, real close to where I was outlining it. Not exactly, obviously, but it's good enough for government work. And the market starts to rally and it takes out the initial high of the day. But more specifically, it aims for these really clean levels. You have this high here, here, and here. Remember I was teaching, just like this level here, the market does not like to leave that. That is not efficient. Now, it's efficient for technical analysis, retail 101, where they'll see that as resistance. It looks perfect. That's what they want because the books teach that. The books are meant to trip you up. So if I'm suggesting, as I mentioned last night in the video, that we would drop down here and then start to go higher, that sets the stage for what? If this is going to be a point at which it reacts and goes higher, as I was outlining around this time period in the video, that means the opposite should be seen for euro. But before we get into that, let's fine tune this a little bit more on the 15-minute time frame. You can see we dropped down, creating the low of the day in London Open. That's our kill zone that I teach here on the YouTube channel. It's 2 o'clock in the morning to 5 o'clock in the morning, New York local time. Market comes down, creates the low of the day, runs back up, back into an order block here, and optimal trade entry, and the market starts to create its run up into the relative equal highs, sweeping that as a daily objective. Now, if this is the low of the day, and at the same time, euro runs all the way back up to the previous week's high, how is this likely to be a false breakout? We have to use intermarket relationships like I'm showing you with dollar index. So if you're trading Forex, it's important to relate your analysis in the trading market. Okay, for instance, if you're looking at euro, that's your trading market. You have to have a barometer, something to measure its movement with, and that's intermarket relationships. So having that with the dollar coming down to a level I outlined last night, that it would be a bullish area, it'd be a sensitive price point to see an advance higher. Because its relationship with euro, it's inverted. So if dollar is going down to that level being 99.92, then it's not a surprised to see euro rally higher as it's doing that. But what is the euro reaching for? This high, and then went so far as to go up above the previous week's high. So they really reached up in there, took out the previous week's high, and at that same instance right there, that's when dollar hit the objective I told you last night. That would be a buying opportunity for dollar. So this is a false breakout because my analysis was done and shared with you openly that would be a buying opportunity for dollar. All right, so the 15-minute time frame, you can see that the euro went up into its kill zone here, 2 o'clock in the morning, 5 o'clock in the morning, New York local time. So it creates the high of the day. So in this price run, we're going to start stripping it down. 2-minute has the very clean fair value gap. So after it ran above that old weekly high, the market trades lower and takes out that short-term low. Now, some of you might see this short-term low and say, well, why didn't you use that low instead of this one here? Well, the reason why is the fair value gap forms right here on this candle. Once that candle closes, the very next candle, it opens essentially right at that low. So it hasn't really moved away and it hasn't really shown you what? Displacement, something energetic where it moves away from that fair value gap. That's the important factor. So we have the fair value gap here and then it moves lower than that short-term low. Now we have a shift in market structure. The market could have came back up into this run here and offered an entry there, but it didn't. Notice that. It went a little bit lower, that's fine, and then rallies up to that level here. This is the entry point. Now, think about where your stop loss would be and think about where your entry would be based on what I taught you using the New York session. So here we have a zoomed in 2-minute chart, and here is the fair value gap level that you would be putting your limit order in. So it gets filled essentially right there. Remember, it's not going to be placed in the marketplace for a shorting opportunity or entry on limit anytime in here because it has to move away from the fair value gap. So it does it on this candle here. So we have that run through this short-term low. We have displacement. It was an energetic move lower away from the fair value gap. It doesn't get to it here. It goes a little bit deeper. We wait. We don't chase it. We don't go in here thinking, oh, well, I missed the move. We still have time. See all this over here? The kill zone for the London Open is still open. So we allow for that retracement higher. Your fill here, that would be your entry, but we're just going to use the actual candle high. That would be your limit order entry, hypothetically. Your stop loss will be above the high here. And the heat or the drawdown that you absorb, hypothetically, if you were to use that entry point, is 1.09301. So basically not even 5 pips. Okay, so with this gearing, okay, if you use sound money management, how much can you risk if you're risking, $1,000 per trade? Okay, you're thinking about money wise, don't do that. You think about it in terms of fixed percentage risk on equity. So that means you're simply going to look at how much money you have in the account, take that, times that by 1%. Okay, 1% is the maximum. Preferably, you should be doing a half of 1% or maybe a quarter of 1%. The teeter-totter effect, or the inverse relationships, that if the dollar's going to go higher, that means that it's going to have weight introduced to euro and it should start to go lower. So your entry here and your drawdown and your stop, all those being what they are here, we go out a little bit further, and I'm just using a 5-minute chart so I can put everything in the fractal. In other words, the fractal is this move up and then down. That way you can see it all and have the candles still be clean and have everything on one chart. So all the levels and things here being as they were on the 2-minute chart. And if you did a Fibonacci run from the low here, why this one? Because it was the most energetic starting this price run here. That would be your parent price leg. 50% is around in here, so that would be a nice objective initially. That would be your first target. If you're going to hold for the full day, it could go down to this area here, and lo and behold, we have that imbalance. The trade rate into that rather instantly.